My name is Paul Nicol, Managing Partner of GFM Wealth Advisory. Warm greetings to our GFM clients and guests who are watching this recording. An update on the Magellan Global Fund being conducted on Tuesday, the 14th of December. We're absolutely delighted to have Hamish Douglas joining us this afternoon in this recording. Hamish is the Chairman and Chief Investment Officer of Magellan Financial Group and also the lead portfolio manager for the Magellan Global Fund. Hamish is extremely well known to our clients, having previously presented in person and via webinars. I'll officially introduce Hamish in a moment. In addition to having Hamish joining us this afternoon, our senior advisors, Patrick Malcolm, James Maliaros and Sam Ely are also joining us on the recording. Welcome, Patrick.
Hello, Paul.
Welcome, James.
Hey, Paul.
And Sam, how are you?
Hey, Paul. Good.
Good. Now, the Magellan Global Fund commenced in June of 2007 with the objective of achieving attractive, risk-adjusted returns over the medium to long term, owning 20 to 40 of the world's best stocks while minimising the risk of permanent capital loss. As a firm, we, GFM, are philosophically aligned with Magellan's focus on downside capture ratio and minimising the risk of permanent capital loss. And back when we started supporting the Magellan Global Fund in 2009, we were incredibly impressed with the breadth and depth of macroeconomic analysis, intensive bottom-up stock analysis and industry research that the Magellan team conducted. Over the 12 years that we've been supporting the fund, we've been very clear with our clients that the investment strategy of the Magellan Global Fund is benchmark agnostic. Put another way, the investment strategy of the Magellan Global Fund bears very few similarities to any market benchmarks or indices. The fund aims to deliver a 9% return over the economic cycle, and most importantly, aims to do so by reducing the risk of permanent capital loss. Over recent times, the Magellan Global Fund has come into sharp focus due to an underperformance against the MSCI World Index. While this focus is understandable, we feel that the objectives of the fund have been overlooked, and we're pleased to say in the period of time that GFM clients have been invested in the Magellan Global Fund, the fund has successfully delivered on its objectives of the 9% return through the economic cycle, while most importantly maintaining its capital preservation measures. So before we get underway with the recording, it's important for those who are watching the recording today to understand that this afternoon's recording is general in nature and it's not personal advice. Should you be seeking more detailed information on what we talk about today with an update on the Magellan Global Fund, please don't hesitate to contact our office and our advisors will assist. So please allow me to formally introduce Hamish. So as I said before, Hamish is the co-founder, chairman, and chief investment officer of Magellan Financial Group and the lead portfolio manager of the Magellan Global Equity Strategies. Hamish is a former member of the Australian Government Financial Literacy Board, the Australian Government Takeover Panel, and the Australian Government's Foreign Investment Review Board and the Forum of the Young Global Leaders, World Economic Forum. Hamish is a director of the Victor Chang Cardiac Research Institute as well. So good afternoon, Hamish, and welcome.
Paul, thank you very much for having me. It's always a pleasure to be with you and the team.
And I'll hand over to Patrick to ask the first questions.
Thank you, Paul. Nice, really easy one to start with, Hamish, just to lead proceedings off. Your CEO resigned in the last week. Can you talk us through how that impacts the business and how it impacts upon investor funds, that resignation?
Well, first of all, I'd say, Patrick, and good to see you as well. I'm obviously disappointed with Brett's resignation. All I would say to you, it was an unfortunate set of circumstances that happened abruptly. Brett, I think, ultimately did the right thing. I can't go into the details behind it, but I respect the decision. There's been no tension between Brett and I. I know there's been some speculation. That wasn't it. You know, in terms of the impact on the business, Brett really, I look after the investment side of the business. There is no impact at all on the investment side. I remain the chief investment officer. I'm not about to start becoming the chief executive officer again. I gave up that position a number of years ago to focus on investments, all the back office and risk and compliance and everything reported through to Brett. We're very lucky that our CFO was actually effectively the COO, where operations reported to her. Her name is Kirsten Morton. And she's immediately stepped into that role while we make a final decision. Obviously, you don't make a decision on a new chief executive in the first day after a resignation, but we're incredibly fortunate that all those critical areas like compliance and finance and operations, they're in very good hands under Kirsten. She is an outstanding leader of the business. So there's no risk at all for any of the clients in terms of the day-to-day operations of the business. There's no change on the investment side. That all sits under me, and it never sat under Brett. I'm disappointed in the situation, but it is what it is. Brett made the right decision in the circumstances, and we will, next year appoint a CEO. I'd love Kirsten to put a hat into the ring, but of course the board will have to evaluate that against other alternatives as well. And we're in no risk with Kirsten in that role. As I say, she's outstanding, and I'd love her to put a hat into the ring. I'm not prejudging what the board will determine, but we've got a very, very strong internal candidate, as well as obviously a lot of phones have been ringing in terms of interest there. But thank you. It's just a pity the media wants to beat up this into a scenario and speculate on all the reasons. And reality is we're in very good hands internally, and we have a very deep bench of talented people.
Never let the truth get in the way of a good story, Hamish.
It's certainly been a good story.
It has been a good story. Questions get easier from here. Just to start with, the long-term performance of the fund since it commenced, Hamish, is unbelievable. Pretty much 12% per annum versus 8% from the index. I think our industry gets very caught up with per annum returns, and I can certainly understand why. It allows you to compare returns over different periods. But when you look at the compound effect of that 11.8% versus that 8.1%, it's 416% versus 213% from the index, which is more than double, which is amazing. And you see the benefit of compound returns there. It's also done it with 3% less risk. We won't get into a debate around how to measure downside capture, but the downside capture is considerably lower under all metrics. I think the most impressive statistic for the fund is of 138 rolling 3-year periods, the outperformance rate is 82%. That's to the end of November. So just to start with, the portfolio construction process that Paul introduced at the start, what does that actually mean when you're selecting stocks for the portfolio, Hamish?
Yeah, well, it's a very good question, Patrick, and this is what people don't really understand, and particularly the media have no interest in understanding. We have a very unique portfolio that looks nothing like the broad world index. The world index is 1,600 companies in every sector in 23 companies, and we have a 20 to 40 stock portfolio of normally around 25 investments. And many sectors are actually completely excluded from what we do, and we're only focused on very, very high quality investments. And how do we get this lower risk than markets, yet have the ability to compound capital at the same time? And our approach is actually effectively having two different portfolios in the one strategy. The first one is we have a very high quality, low risk defensive equities portfolio. So within this portfolio, we own consumer staples like Nestle and Procter & Gamble and PepsiCo. We also own some utilities and some infrastructure investments in that, and some quick service restaurants. And that's about half our portfolio, including if we hold cash from time to time, we make up half the portfolio. And we're aiming for 8% return out of those very low risk assets. And the thing about having, half your portfolio in those super high quality but defensive companies is when something goes wrong, and something always does go wrong through the cycle, they provide enormous buffer for us. And then it enables us to really focus on some incredible compounding opportunities. We've had 7 investments that have gone up 5 to 10 times since we've owned them. So if we put 5% in an investment that goes up 5 to 10 times, we will make 25 to 50% return on your client's capital from that single investment. And therefore, we're focused on finding those, we call it structural growth. We have a higher rate of return because there's more risk. We set a return of 12% per annum for those. That is where some of our famous stocks we're famous for, like a Microsoft or a Alphabet or Visa card or MasterCard would fit into the portfolios. Netflix is a new investment. And if you balance these two different portfolios, 50% in an 8% returning very low risk portfolio and 50% in a higher returning 12% returning portfolio, this is where you get about 10% per annum. Take off the fees, you get 9% per annum. So we're solely focused on that return objective. And then we're really focused on trying to get much less risk when the markets go down. And we've achieved that over time. So it's a very, very different portfolio construction. It looks nothing like the market at all. We really believe that they're getting return on your capital with an appropriate amount of risk. And if we can get you a 9% return with less risk than markets over the long term, I think that's going to be a very satisfactory outcome for people. And we're not about to change course, Patrick, because we've had a few bad media articles.
No, nor should you. And just, I did say at the start that the questions were going to get easier. That was perhaps a lie, Hamish. Now, the 9% per annum return objective has been achieved over 1 year, 3 years, 5, 7, 10, all the way through to inception. But I think the industry loves relative performance, and it goes without saying that it's been the fund's toughest period of relative performance against the index. Hamish, can you talk us through the two largest drags on returns in recent times, which are obviously the cash positioning late in 2020, as well as the position in Alibaba, if that's possible? And also, I guess, what changes you've made since that as well, Hamish?
Yeah, Patrick, it's a very good question. I would say up until the 31st of October 2020, before these vaccines were discovered, the strategy had nearly outperformed every single benchmark you could ever find by large margins. And it's true in the last 12 months, only the strategy has had a material underperformance versus the market. We've actually had equal outperformance when markets have been down. But really, what was the reason in the last 12 months why the market was explosive? We made a 12% return, which is actually above our return objective over time, but it was materially less than the market returned in the last 12 months. You mentioned cash and Alibaba. The cash actually wasn't really the reason for the drag in performance. Actually, we were largely out of cash by the 31st of October 2020. And actually, we were materially outperforming right up until that point. So it's true we used cash during the depths of the crisis of the pandemic, and it may have dragged a little bit, but I'm not making an excuse for the cash to say it was cash. It actually wasn't cash. It really falls into two big reasons. We have 50% of the portfolio allocated to these very defensive equities. The market has about 20% allocated to these assets. What actually happened in these businesses like Nestle, Procter & Gamble, Reckitt, Novartis, McDonald's, Yum Brands, Utilities, Crown Castle, which is an infrastructure company, if you look at all their underlying results, the results have been fantastic. And I have huge confidence that they continue going to deliver 8% at least returns with lower risk. Probably over the next little while, they'll deliver more than that because there's been a big rotation. But, they went up actually 7% last year and a market went up nearly 30%. If you've allocated half your portfolio to those style assets, it didn't matter what you bought in consumer staples and utilities and others, they materially lagged the market in the last 12 months. We're not about to chop and change our risk metrics because of what happens in a 12-month period. 60% of the underperformance was purely related that we always hold half our portfolio in very low risk assets. They will continue doing the job over time that we want them to do. It's a very extreme event that those type of assets would lag a market this much. I think I'd put it a 1 in 50 year event that happened after these. We haven't seen a sort of divergence in 50 years for these sort of assets versus the market. And we know no one wanted to own low risk assets. Everyone wanted to put risk on. It was the most extraordinary period. And that is most of the reason the strategy underperformed, about 60%. The rest of it was actually our allocation to two stocks in China, and which were Tencent and Alibaba. And frankly, I made a mistake there. I made a mistake in buying both of them because they're actually correlated. And we had material positions, mainly because they went up so much in price. The year before, they were dramatic outperformers. But right at the same time, we had these vaccines discovered. China cracked down on its technology sector in China. And wherever you've been, it's been a painful period. So while the market went up 30, these sort of went down 25% in this exactly the same period. In an absolute sense, they took off 3 percentage points of return. So without these, we would have done 15 instead of doing 12. Relative to the market, because the market went up and these went down, it took off 6 percentage points relative to the market. We're now out of Tencent. We actually make money in the whole ownership of Tencent. So it's not like it didn't cost anybody something, but we've decided we're not going to hold as much correlation risk in China there. And we've actually tightened up our risk controls on technology platforms outside of China because of this. Every now and then you something happens which you learn something from, and you make a mistake. And I made a mistake on that, but it's not going to repeat itself. Alibaba, which we still hold that we think is incredibly cheap, is less than 4% of the portfolio. So whether we're right or wrong on Alibaba, please, no one should lose any sleep over that. Obviously, we think often when things seem most painful are the best times to own them on a forward-looking basis. And it seems very painful owning Alibaba at the moment, but it's incredibly cheap. I was also too conservative around the vaccines results. We did a lot of work on the science. We decided not to gamble on those results and put some extra risk in the portfolio. In hindsight, that was a mistake. We could have nearly bought anything of risky nature. If you'd bought it in October last year, in hindsight, it was shooting fish in a barrel. You almost could have bought anything. And we just decided not to because we didn't want to take excess risk. So our conservatism cost us a little bit. But I put that at the margin. Most of it was structural, which is a long-term capital preservation allocation we have, and China was was my fault, and I accept that we were too exposed to those two companies in China last year.
Understood. Thank you, Hamish. I think it's over to you now, James.
Yeah. So Hamish, thanks for that answer. So on the back of the answer that you gave just previously, how can you give us a broad overview of how the portfolio is currently positioned, please?
James, I'm very happy. Nice to see you as well. Not a lot changes at Magellan, believe it or not. With all this sort of chaos going on, we haven't changed dramatically. We are down at 5% cash, which is less cash than we've held for quite some period of time. And between 2 and 5% in all respects, we're kind of fully invested in the strategy. So it's not like we're sitting here calling the whole world's about to end and we're sitting in lots of cash. We can talk about risk in a moment, and we are in extraordinary markets. We continue to have a very high quality portfolio of defensive equities, and not much has changed. We still hold our core quick service restaurants, Starbucks, Yum Brands, and McDonald's. We own, I think, 3 or 4 of the world's best consumer staples, with Nestle, PepsiCo that owns a fabulous Frito-Lay salty snack business in the United States, Procter & Gamble, which would have the greatest portfolio of brands in consumer staple brands in the world, and Reckitt out of UK that owns Dettol and Strepsils and Nurofen and Finish dishwashing tablets, Nappy-Sam and others. We've got 3 US utilities at the moment. We've got 1 infrastructure company that we've owned for quite some time. It's done very well, Crown Castle, which owns communication towers for 5G networks in the world, and a healthcare company, Nevada. See, this is a collection of outstanding businesses. They're very defensive, and I've got great degree of confidence. They just haven't outperformed the market in the last 12 months, but I have a lot of confidence. We haven't chopped and changed really what we're doing there. We've changed slightly the weightings in things over the last 12 months, but not a lot has changed there because we actually have confidence in them. We have materially lowered our exposure to China, I just mentioned. We're up at 15% in Tencent and Alibaba at its peak back in end of October last year. We now have less than 4% of the portfolio in those. So, we've corrected our exposure there. We think Baba's going to work out pretty well. That's Alibaba. Baba is its stock code, but you shouldn't lose any sleep if we're right or wrong on that call. The remainder of the portfolio is in great sort of structural growth. We've got a little bit of cyclical travel exposure in the portfolio at the moment. It's super high quality and we think attractively priced. We're in a whole different series of themes. People may say it's technology, but we're in the cloud infrastructure layer through Amazon with Azure, through Amazon now with AWS, through Alibaba, and through Google. They all own the world's leading cloud hosting platforms. We've got a fabulous exposure to enterprise software. This is business software in the world. Microsoft will be the leading company in the world, but also SAP. We own the two big advertising platforms still, Google and Facebook. We own the payments networks, Visa and MasterCard. ICE, which is Intercontinental Exchange, owns one of the best futures exchange franchises in the world, but it's really gone into the mortgage industry in terms of digitalising the manual process of mortgages in the United States, which we think is going to work out incredibly well. E-commerce, we've got a very small position in Amazon. We wish it was cheaper. And we own Alibaba. It is cheap, by the way, Alibaba. So one cheap and one not so cheap. And then we've got some travel exposure, which is new. We'd love to get bigger. We hope Omicron would shake the markets up a bit so we could actually get something more material there. But we've bought two exposures in two travel companies. So the last thing I'd say about our portfolio, it's still very well balanced. We're not chopping and changing what we do. But this movie isn't over. You know, we had the first chapter when the pandemic struck. Our portfolio was incredibly resilient against what happened in March 2020 when this pandemic struck. Then after the vaccines were discovered, we lagged because there was a massive cyclical risk-on rally, but we delivered a 12% return, but the markets delivered more. And the last third of this movie could well be the most interesting here. We are... Charlie Munger said last week, this is more extreme than 1999. And, you know, one of the examples I give people is the week before last, a great company called DocuSign reported, and it gave guidance for the next quarter, and their revenue guidance was marginally less than the stockbrokers' estimates for it. And when they gave that guidance, its stock price fell 40% in a day. I could probably give you 200 well-known companies that could fall 40% in a day here. That's as extreme as what is occurring at the moment. You just need to be very, very careful in this world, and that's why I'm saying the movie isn't over. The press is judging us at the moment for being conservative, but let's see how this ends at the moment. You know, if it's fine and we get out with the thing, returns from here are going to be absolutely fine. But if one of these things makes this movie come unstuck, I think you'll be saying, "Thank God we hold Magellan." At the end of, I'm not saying it is because we're at 5% cash, but we're pretty well positioned, and there's some pretty obvious things that could go wrong at the moment.
Okay. Yeah, it's really interesting. Interesting analysis, Hamish. Thanks for that. One of the sectors I know that you've always been involved in since we've been recommending Magellan is around those so-called FANG stocks. Okay, well, obviously it's a slightly different acronym now because of
they keep changing their names. So
yeah, that's right. Keep changing their names. Yeah, that's right. I don't know. You keep on top of it, but anyway. So that performed exceptionally well since the height of the pandemic. You know, we've noticed companies like Facebook. It's made over 700%. Google 800%. Apple 900%. So there's some massive numbers in there. Even Amazon 1,500%. So huge numbers. They're about 11% of the overall global share market. My understanding is that you've got roughly 22% as at the end of September in those particular types of stocks. So can you talk us why you still have a position in those stocks, a quite overweight position in those stocks? And I suppose one of those parts of FANG is Apple. So it's the largest of the five companies to almost reach $3 trillion in market capitalization. But it's the fund's largest underweight position. So maybe talk us through some of those stocks that we've just mentioned.
Well, James, the first thing is, we don't think about overweight and underweight. We never look at an investment and saying, well, how should we position ourselves versus the weighting of that stock in the MSCI index? We're only 25 companies out of 1,600. So there's obviously 1,575 stocks that we're totally underweight, 100% underweight. So we don't get ourselves too caught up being underweight 1,575 companies in the index. And by definition, whatever you own, you're probably going to be materially overweight because our portfolio is so different from the index. But the real question is, why are we in these stocks, particularly some of these stocks where we've made so much money? Microsoft would be at the top of the list. We're up over 12 times our money in 7 years in that. So when we were up 500%, the same question is, why didn't you sell it? It's up 500%. I remember when we were up 100%, a number of people, we bought it at 28, and when it was about 60, a number of people in the time said we should sell it. And I said, why in the hell would I do that? I said, it's only just getting started. And this is really the power of compound returns. So Microsoft, although we're up 12 times our money, Why have we still got it the largest position in our fund? And that is because we think there is a very high probability in the next decade we'll compound our capital around 15% per annum. And at 15% per annum, which is well above our 10% objective, we will end up making 4 times our money from here by holding Microsoft at this place. It's not going to go up another 10x. And, we're looking for those ones. But, a 15% compound return over a decade is a fabulous return. So notwithstanding we're up 1,200% in Microsoft, we always look on a forward-looking basis. We don't think about what we paid or anything else. We look today and we look at the future and we try and make an assessment whether or not we're going to get a very decent rate of return. We feel exactly the same on Netflix, which is a more recent investment. I would have loved to have bought it 9.5 years ago. I didn't. I bought it about a year ago. It's obviously done pretty well in that period, but we're taking a 10 to 20 year view on this. And we think Netflix is a no-brainer at these levels. Its stock price in the next year will reflect what its subscriber growth does versus market expectations of it. I have no idea whether Netflix is going to underperform or outperform the MSCI index in the next 12 months. But I have a very high conviction it will kill the market over the next decade. And we don't get caught up. We really take a long-term view here. And the same thing is on owning Amazon. We don't think we'll get as high a rate of return. It's a much smaller position in the portfolio. It's a fabulous business, but we then scale them to how cheap we think they are. Ultimately, what rate of return? And you ask what we got out of Apple. We went into Apple in a very big way when it was very out of favor, and we made it a very large investment. And we sold it over a year ago. We looked pretty stupid selling it, but it got past our valuation. And we just don't think it's worth what it's trading at, is our assessment. We may be wrong in that, but that's our genuine view. And if once things pass our valuations, we won't own them anymore. That's the discipline we have. And we see things in people's portfolios where things have gone from 30 times earnings to 65 times earnings, and earnings may be up 10%. And we turn around and people look like heroes. But riding up a multiple expansion of that degree, we can't understand how someone could have any credible case while they're still in the portfolios. Markets get it wrong from time to time. And if you're lucky enough to ride up a wave and jump off an overvalued wave, we get off before we think it's dramatically overvalued at the end of the day. So each of the ones we hold are the ones where we think there is good forward-looking returns. And each one we sold, like Apple, we think they become fully valued in our assessment. We could be wrong. But, we're trying to make that assessment of value each time we make a decision.
Thanks, Hamish. Very comprehensive. Sam, I think you're up.
Thanks, James. Hi, Hamish. I just had a couple of stock-specific questions as well. So the first one was about Starbucks, which you mentioned sort of in passing before. But, this is one of the fund's larger positions. I'm just wondering, as clients, we're pretty familiar with Starbucks as a brand, but what's the investment story behind Starbucks? And do you consider it one of the sort of more defensive positions, or is it a structural growth stock in your view?
It's a very good question, asking if it's defensive or it's structural growth. And the great thing about Starbucks and even Yum Brands, they're both. They sit right in the middle of the field between defensiveness and growth. Starbucks has nearly 34,000 stores in the world. It's got like 14,500 in the US and 5,400 in China, and it's rolling out 2,000 stores a year. That is a 6% growth just from its store rollouts around the world. China is actually growing at 600 per year, or 30% of its total store growth. And they're getting a return on capital out of their China expansion, about 80% return on capital when they're opening a store, which is absolutely extraordinary. And the model is very simple. They're going to end up between store rollout and same store sales growth, which largely comes through transactions and pricing, in the high single digits revenue growth, which is going to deliver low double digits earning growth, plus the free cash flow yield. We're going to be compounding in the mid-teens of owning Starbucks. That means every decade, you're probably going to be earning 4 times your money. It's a bit like I took you through Microsoft. And the other thing we like about it is it's very defensive as well. The great thing about coffee, it's addictive.
I can attest to that.
The other thing about their business, the economic moat is incredibly wide. Their US business, which is their powerhouse, and now their China business that is getting to that, is incredibly hard to disrupt at the scale that they're operating. They have massive daily engagement. Coffee is one of the most frequent purchases in the world. So most of their customers are coming in 5 days a week, some 7 days a week, and they've got digital relationships with so many tens of millions of people. And they've then got this incredible alliance with Nestle in rolling out its brands in supermarkets and actually in hotels and airlines and everything else. It's been a fabulous success, which gives them more brand amplification plus great economics on that. And actually, they've got incredible management. Kevin Johnson is incredible. He comes from technology background. He understands digital. He gets that business. Believe it or not, Satya Nadella, who runs Microsoft's on the board of the company. Not that he's driving it, but just the quality of people they have there. So it's just this wide economic defensive business with growth. It's like we do it. Obviously, it's a little complicated. It's in China. There's tensions between China. That's where the risk is in this. It's China. There's 2 short-term issues. They've pushed through wages increases in the United States. They're going to lag slightly before they take pricing that will pressure margins this year. I think they'll take pricing more quickly than they're letting on. But the year after that, they'll fully have it back. And China is slightly clouded by they've got a zero tolerance to COVID. So not all their restaurants are open at the moment in China, but they're still rolling out 600 a year despite that. As soon as China reopens, all those sales come back in China. We have a lot of confidence. The risk is around China there, but it is really a fabulous business, a sort of growth defensive company, which is kind of right in the centre of our pitch.
It sounds like it's in the sweet spot.
It really is.
Thanks, Hamish. Also, just one other question. You mentioned a little bit in passing before about intercontinental exchange, which is one of the newer positions. Just wondering if you could elaborate a little bit more about, I suppose, this business and why it's now in the top 10.
Yeah, again, it's a super high quality business. The thing about futures exchanges, and they also own the New York Stock Exchange. People may have heard of the New York Stock Exchange. It's a small part of their business, but their futures exchanges, what tends to happen is the contracts become monopolies. So they have all the futures contracts over the Brent oil contract. They have it over a whole series of natural gas and LNG, and they've actually got the core contracts, futures contracts over European interest rates. They're also developing a business which they're doing end-to-end digitalisation of the manual process of origination and closure of a mortgage in the United States. And that is probably going to be a $10 billion revenue opportunity ultimately for them. And it will end up being an oligopoly or maybe even a monopoly the way these things work, because you actually want to go, and it saves so much money and time in the industry from digitalisation of that industry. And what they also do is from each of their key contracts and now from mortgages, they get all the data and then they sell that data to market participants under subscription. So traders actually want all the data on crude and natural gas and LNG and interest rates. And now on the whole mortgage market in the United States, are going to have data that people have never had before on defaults and everything else. So if you're a trader in this, you want to buy their data subscription services. And at the very last, it's run by a guy called Jeff Sprecher. He started this by buying one of the original exchanges for $1. It's now worth over $60 billion. Jeff Sprecher is one of the absolute geniuses in the financial services industry, and he has done things and taken opportunities, and he will do things again in the future that create enormous shareholder value. So because of the nature, it's incredibly defensive, but it's got this real growth underpinned by what's going on in mortgages. It's a very, very unique business. And we love businesses like that. And we were buying a business, some of the MSCI is trading, which is a fabulous business at over 60 times earnings. And, this is trading at 20 something times earnings for one of the, and just look what, these are much better business than the ASX. And the ASX trades at materially higher multiples.
Mm. Yeah, it's super interesting. Thanks, Hamish. Over to you, Paul.
Hamish, I'm just going to shift the focus a little bit, if you don't mind us focusing on the macroeconomic environment.
I'd be surprised if you didn't, Paul.
Well, we've got to ask some opinions, Hamish. So look, there's obviously considerable debate and uncertainty as to whether prolonged inflation will re-emerge as a threat to markets and whether central banks will be forced to tighten monetary policy because of inflation. So the question is, have you altered the portfolio's position around the inflationary pressures that are in the system, and especially if there is the potential for higher interest rates?
Yeah, what I would say, Paul, to start with is just maybe outline the importance of this question of what inflation really means. The markets are betting it's transitory, these inflation pressures. It's a temporary phenomenon, and we will have a very modest tightening of interest rates, maybe a few rate rises in the United States next year, and that's what the Fed is signalling here. If there are just a few rate rises and inflation dissipates, everyone's got nothing to worry about, and this expansion will go on for another 18 months. The risk is what happens if this inflation is persistent, and by the middle of next year, I'd say, is the real timing point that it starts to become embedded in consumers' price expectations. And it really is what has happened here, which has created this inflation, is because it's a pandemic-caused event. So what happened is we're all locked down. We all had our incomes. We didn't spend our incomes because we didn't go out. So we built up our savings. And then what we started to do when we're all locked down at home, I'm talking about us as the world, we all started buying goods. And we started to doing things at home. Instead of going to restaurants and going on holidays, we were spending this money at home. And actually the demand for goods took off and went to much higher on a monthly basis than we've ever seen of consumption of goods in history. And at the very same time, we had supply chains which were being asked to produce more than they've ever been producing before, to ship more than they've ever shipped before, and they were being affected by the pandemic. And therefore, it's not surprising transportation costs went up. They were asking to ship more goods than ever. There's only so many container ships in the world, and they're asking to ship more. When they arrived in the west coast of America, there were labour shortages. They're all queued up off America. Manufacturing. So you can see why with the pandemic, this has caused an event. You would expect if we just reopen the world, as people move around, they'll start consuming services rather than goods, and we would anticipate this to normalise. But we've now got Omicron happening here. And Omicron may well put us back in a world in 8 weeks' time or so where we're having to lock down again. I know people don't want to hear this, but it is unfortunately a brutal reality of what this potentially could be. And therefore, this switch to services may not happen. And if we don't get the switch to services, this elevated inflation could remain. And if we get into the middle of next year, and you really have to look in the United States, because that's where the monetary policy that really matters to the world's asset markets is set. We've got an election next year, and inflation has already become the biggest topic of the United States. So people cannot turn on a television without being told about inflation. So how do you keep it out of people's expectations? If this hasn't reversed by the middle of next year, I would say that the game's up. And if the game's up, the market and the central banks may well have to start tightening monetary policy much more materially than anyone's thinking at the moment. And that is really ugly for asset markets if that was to occur. And the problem is, since 2009, when asset markets fall, central banks have stepped in and eased monetary policy and printed money to buy assets. But if it's inflation, they're actually going to be doing the opposite. So the central banks won't be here to help if this is the problem in the world. And if they're not here to help, the world is in for a very, very nasty shock if that was to happen. I would put a 30% probability. It would be wonderful for Magellan. You ask of how we're positioning ourselves. We've got a very unique portfolio, very high return on equity companies that are asset light. We've got pricing power throughout the portfolio. We've got compounding earnings. We've got relatively low economic sensitivity because we're not in commodities and other things, and we're not in banks. Some people go, if you're worried about inflation, buy commodities and buy banks, buy the cyclical stories. It just is the most stupid thing in the world to buy. No one's studied inflation in the past if they believe owning a bank's a good thing to own. They think because interest rates will go up, banks will earn more money. The problem is, if this really happens, we're going to have a global recession. And I'm not saying it's going to happen, but what are we doing? Basically, we're not that worried about it from our portfolio. We've done things at the margin. We're selling things that look expensive. We're careful about where we go in cyclical related assets. We've lightened our exposure to utilities, probably at the more pointy end of rising interest rates, but very defensive against a recession. So they're kind of they're pluses and minuses on them. So if this happens, people are going to be very happy they own Magellan. But I'm not saying it's going to happen, but people have to understand that there is a very complex interplay going on here with this pandemic and Omicron and the inflation topic. And there could be an absolute red herring here. And one red herring, you never know what really brings this unstuck until you see it. It could be something we can't see. I would put Israel and Iran in this question at the moment. You know, the Iranians are racing towards enrichment at their nuclear facilities. It doesn't look like we're going to get a deal with the Biden administration and Iran. And there is a reasonable possibility that Israel would strike Iran in the next 6 months. And Iran normally retaliates against, believe it or not, Saudi Arabia's oil facilities. That is the last thing the world needs when there's an inflation threat, to have a major shock in the oil markets over that. So there are things we may not even see at the moment that could trigger this sort of massive change. The world is betting transitory at the moment. I think there's a 70% probability that bet is correct, which isn't conducive to say our performance will dramatically improve relative to markets. But if we get a major event that changes the direction of this, as Munger said, we're in the most extreme market conditions, and you could literally finding well-known companies in people's portfolios dropping 40 to 50% in a day. If this view was to change, there are massively crowded trades here that won't respond well to a change on this particular topic. I'm not saying it's going to happen, but there's some people who are playing with fire at the moment, Paul.
Yeah, this is fascinating, Hamish. I just want to drill in on this 30% probability that we're not dealing with transitionary inflation. Are you suggesting that the companies that you own in the Magellan portfolio perhaps have a pricing power that somewhat protect them against this probability of a period of prolonged inflation?
Yeah, I think we've got a very unique portfolio of assets here. You know, companies like Procter and Gamble and Nestle and PepsiCo and Starbucks and Yum Brands and McDonald's, they have very unique pricing power in the ability to put it in. And they also get, a number of them, they get a trade down benefit for what happens. As people move out of restaurants, they go more into home. And if they trade down in restaurants, they go out of fancy, they go into things like McDonald's in the business. So they get, if we have a real recession, they kind of are the beneficiaries of recession. And if it's inflationary, we think they can increase their earnings in line with the inflation effect. And if they increase their earnings with inflation, they effectively offset the discount rate increase because of the increase in interest rates. Utilities are at the more pointing end because they can maintain their earnings, but they can't increase their earnings. They can offset price increases, commodity price increases and so forth, and wages increases with an increase of the revenue line, but effectively their earnings stay flat. So they do get an impact on that. But on the other side, if the world is going to face a recession, utilities are very good things to own, so they get cushioned a bit. And then we have other things that really, Alphabet's sort of valuation is really independent on how it's still growing. Here, their kind of growth, we can compound our way. And if you get a change in the discount rate and you get a movement in the PE multiple, you compound your way through that pretty quickly with some consistent growth. There, we're not immune from it. Okay, a real inflationary environment is a very ugly environment for asset prices. I would pencil at least a 30% off here for markets, but I think we've got an enormous amount of resilience. We're not going to be zero down if the markets are down 30. You know, please don't people go away and think that's going to happen. But I suspect things like Nestle and Novartis and McDonald's and Procter and Gamble, they're going to be, some of them could be up in a down world like this, or be down very little, and you know, we will have some exposures elsewhere in the portfolio that go down, but in aggregate, I think it's going to hold up pretty well. But I'm not calling it, Paul. I'm calling a 30% probability of that. But the longer this goes on and the more we get disrupted with Omicron, the probabilities may well be heading up here.
Yeah, and you know, in this COVID environment, Hamish, we've seen aggressive monetary policy, we've seen unprecedented fiscal stimulus. Governments around the world have record levels of debt. So a question we regularly get asked by our clients is, how big a risk to the financial system is this record level of government debt? And perhaps an extension to that, Is Magellan concerned about the level of corporate debt that's in the system? Do you see a possibility of downgrades and defaults coming up in an environment where interest rates may go up?
Yeah, you're asking a very complex question here, Paul, and you're asking, I think, a three-pronged question here. First of all, I would say that the central banks are more snookered here if we get this scenario, and QE and the level of government debt. It's also going to limit the ability of governments to respond in a fiscal sense, because if the central banks aren't able to print money, because printing money would be more inflationary, then governments are less able to spend money because of their debt load. So they can't offset that with fiscal, because all the fiscal expansion that's happened, who's bought all the government debt? It's been the central banks. So suddenly you find in this situation, the central banks are hamstrung. Now governments are hamstrung to respond. So it makes it much more difficult to support the situation if truly we get inflation. So I do think the level of government debt has added a complexity on the scenario of responding to an event we haven't seen since the 1970s, if it was to happen. Therefore, could be quite brutal. Are we worried about the financial system per se? I think the banking systems are in pretty good shape in terms of liquidity and other things. Of course, we get a recession, they have debt, but I would say in the corporate debt side of things, we have so many companies that are now high yield and now sitting at the BBB line. The risk here is if we have an economic downturn, you would have a whole lot of companies falling from BBB to sub-BBB, and that means they're called fallen angels. And if we had them hitting that, there could be massive sort of domino effects in credit markets of that sort of falling credit rating agencies thing that could become self-fulfilling on asset prices there. So, you know, what has happened in the last 10 years as rates have fallen, companies have leveraged themselves up to the sort of limits of investment grade credit. And if you have a fall in demand and interest rates going up on you, you could actually find a whole lot of companies toppling through that line. And the issue is most people who hold them are suddenly prohibited from holding that credit. You know, are the central banks going to step in? They were very, very worried at the beginning of the crisis of that risk in credit markets happening. And they provided liquidity lines and did a whole series of things there. So, you know, I would say inflation, if it happens, is such a complex scenario and such a dangerous scenario for asset prices if it was to occur. But I think the financial system's in really good shape at the moment. But as I say, you've asked a three-pronged complex question there.
Hamish, I won't ask any more questions. We're just about out of time. Look, on behalf of the GFM team, we've got to say thank you. You're always very generous with your time with us. So on behalf of the GFM team and our clients, thank you for all your good work that you've done over a number of years in our clients' portfolios. We wish you and the Magellan team a Merry Christmas and the very best of luck for 2022. Thanks for your time, Hamish.
Thank you, Paul. It's been a pleasure.
Thank you, Hamish.
Thanks, Hamish.
Thank you, guys. Thanks, everyone. Very safe Christmas.
Yeah, you too, Hamish. Thank you very much, and all the best for next year.
Thanks.
Thanks.